Despite six-figure salaries common in finance and tech, a shocking 40% of high-income households struggle with debt and insufficient savings. This isn't about income, it's about a silent thief. You landed that big promotion, a significant raise, yet your bank account barely budges. Ever wonder why your wealth isn't growing proportionally? The goalposts of your lifestyle keep moving. Consider a Wall Street VP earning $500K, yet trapped by a $10K mortgage, luxury car payments, and private school tuition. Their rich life is a fragile house of cards, not true freedom. This invisible trap is lifestyle creep. As your income rises, so does your spending. Slowly, imperceptibly, your needs expand to fill your entire new financial capacity, leaving little extra. It begins innocently: a slightly better apartment, a fancier coffee, a subscription service. Small upgrades feel earned, deserved, a reward for your hard work and newfound success. Perfectly logical. Soon, these upgrades become necessities. That premium gym membership, the weekly fine dining, the latest tech gadget, they all transition from wants to perceived needs, essential for your lifestyle. At its core is hedonic adaptation. We quickly get used to new pleasures. That initial thrill of a new luxury fades, and we seek the next high to maintain our perceived happiness level. Then there's social comparison. Surrounded by colleagues or neighbors' lavish homes and exotic vacations, the pressure to keep up becomes immense, almost subconscious, especially in high-status circles. The result? Your savings rate stagnates or even shrinks. Despite earning significantly more, the percentage of your income you save for the future remains stubbornly low, or worse, drops. It's a zero-sum game. Every dollar spent on lifestyle creep is a dollar not invested. Imagine that $500 extra monthly spent on dining out, compounded over 20 years at 8% returns. That's over $250,000 lost. This isn't just about missing out on money. It's about delaying financial independence. Every lifestyle upgrade adds another year or two to your working life, chaining you to your job longer than necessary. For many, especially in high-pressure fields like finance, lifestyle creep creates golden handcuffs. You earn a lot, but your expenses are so high you can't afford to leave, even if you wanted to. In Silicon Valley, a $2 million starter home and 2 luxury EVs might be normal. This rapidly normalizes extreme spending, making true wealth accumulation incredibly challenging for many tech professionals. On Wall Street, the pressure extends to bespoke suits, exclusive clubs, and Hamptons rentals. These aren't just expenses, they're perceived entry tickets to a certain status, blurring lines between personal and professional. Studies show that even for top 1% earners, their savings rate often doesn't significantly outpace their income growth. Many are only marginally better savers than the middle class, relative to their earnings. Part of the why is emotional. We seek comfort, validation, and a sense of achievement. Spending becomes a quick, tangible way to feel successful, even if that feeling is fleeting and unsustainable. It's often not a lack of income, but a lack of a proactive financial mindset. Without clear goals and a disciplined approach, money simply flows to the path of least resistance, spending it all. First, track every dollar. Understand exactly where your money goes. Use apps like Mint or Unab. You can't fix what you don't measure. Be brutally honest with your spending habits. Automate your savings and investments before you see the money. Set up direct deposits to separate accounts. Make saving non-negotiable, like paying a bill. Pay your future self first, always. Define your enough. What truly brings you joy and fulfillment? Beyond a certain point, more spending rarely translates to more happiness. Prioritize experiences over possessions for lasting satisfaction. Practice delayed gratification. Instead of instant upgrades, set specific savings goals for larger purchases. This builds financial discipline and prevents impulsive creep decisions from taking hold. For every raise, commit to saving at least 50% of the net increase. Let the other 50% be for lifestyle, if truly desired. This ensures your savings rate always climbs, building real capital. Challenge the social norms around you. True wealth isn't about conspicuous consumption, it's about freedom and optionality. Be confident in your financial choices, not dictated by others' expectations. Remember the power of compounding. A small, consistent saving habit diligently maintained over decades will far outpace sporadic high-income but high-spending approaches. It's the tortoise, not the hare. The most dangerous phrase is, "I'll save later when I earn even more." Lifestyle creep ensures later never truly arrives, because your needs will have expanded once again, trapping you. Think of your future self. What kind of financial freedom do you want for them? Every dollar you save today is a gift to that future self, unlocking choices, security, and true peace of mind. Lifestyle creep is an invisible, insidious trap. It preys on our psychology, turning earned success into financial stagnation. But awareness is the first, most crucial step to breaking free and building lasting wealth. Take control. Master your spending, define your true values, and reclaim your financial future. Don't let your hard-earned income slip through your fingers. Start today for lasting prosperity. Many debts appear harmless, even necessary. But some are insidious, draining your financial vitality. We call these bad debts. They diminish wealth without significant future return. Consumer loans often provide instant gratification, creating an illusion of affordability. But this short-term gain frequently leads to long-term financial pain, eroding your net worth over time. Let's start with car loans. A new car loses 20–30% of its value in the first year alone. You're financing a rapidly depreciating asset, often for 5–7 years, losing money from day one. Consider a $40,000 car. After 5 years at a 5% interest rate, you've paid over $5,000 in interest. Your car is now worth maybe $15,000, yet you paid $45,000 for it. That $750 monthly car payment could be invested instead. Over 5 years, compounding at just 7% annually, that's over $50,000 in potential wealth, not a rapidly depreciating asset. Many car owners find themselves underwater, owing more than the car is actually worth. This negative equity makes selling difficult and often traps you in a continuous debt cycle. To mitigate this, buy used cars, ideally 2–3 years old, past their steepest depreciation curve. Pay cash if possible, or seek the shortest loan term to minimize interest. The allure of a new car is powerful, driven by marketing. Dealerships capitalize on this, focusing on low monthly payments rather than the total cost. Don't fall for the new car smell trap. Car debt directly subtracts from your net worth. It's a liability that doesn't build equity, making true wealth accumulation significantly slower and harder to achieve. Now, credit cards. They offer convenience but carry average interest rates of 20% or more. This isn't just expensive, it's financially devastating if not managed with extreme discipline. The minimum payment is a psychological trick. It makes large balances feel manageable, but you're primarily paying interest, barely touching the principal, and prolonging your debt. A $5,000 balance at 20% APRA with a 2% minimum payment could take over 20 years to pay off. You'd pay upwards of $7,000 in interest alone, wasting significant capital. For many, credit card debt becomes a forever debt. You keep making payments, but the balance never truly diminishes, creating a constant, heavy drain on your available cash flow. Using credit cards for emergencies without an established emergency fund is a double-edged sword. You solve one immediate problem, only to create a more expensive, long-term one. Present bias makes us value immediate rewards over future ones. Credit cards exploit this, letting us buy now, pay later at a steep, often unforeseen, future cost. We often categorize money differently. Credit card spending can feel less real than cash, leading to unintentional overspending and accumulating debt without full awareness. High credit card utilization and missed payments severely damage your credit score. This impacts future loan rates for houses or vehicles, and can even affect job prospects. Prioritize paying off high-interest credit card debt using methods like the debt snowball or avalanche. Focus on one card at a time for maximum psychological and financial impact. Car payments and credit card minimums combine to create a significant monthly drain. This debt service dramatically reduces funds available for saving, investing, or true wealth building. Every dollar spent on interest is a dollar not working for you. This dramatically slows down your ability to build wealth and achieve financial independence year after year. While your car depreciates, your credit card debt often grows. This double whammy actively erodes your net worth, pushing you further and further from your long-term financial goals. High consumer debt makes you financially vulnerable. Any unexpected expense or income disruption can quickly lead to default and deeper, more severe financial trouble and stress. Many feel consumer debt offers freedom, but it's an illusion. True financial freedom comes from minimizing liabilities and maximizing income-generating assets, not accumulating more debt. Shift from a consumer mindset to an investor mindset. Every purchase decision should be evaluated by its long-term impact on your financial future, not just immediate gratification. Focus on building a robust emergency fund first. This acts as a crucial buffer against unforeseen expenses, preventing reliance on high-interest debt when life throws a curveball. Systematically eliminate bad debt. Create a clear plan, stick to it diligently, and celebrate small victories. This frees up cash flow for true wealth-building activities and investments. Adopt smart spending habits, delay gratification, differentiate needs from wants, and always consider the total cost, not just the attractive low monthly payment. By understanding and actively avoiding these common debt traps, you reclaim control of your finances. You transform liabilities into assets, ensuring a stronger, more prosperous financial future. Today, we tackle financial giants buying a home, securing insurance, and navigating dual income dynamics. These decisions, though seemingly straightforward, hold significant hidden risks that can derail your financial future. First, the American dream homeownership. Many focus solely on the mortgage payment. However, bank pre-approval often reflects maximum lending capacity, not your comfortable affordability, leading to overextension. Beyond the principal and interest, hidden costs accumulate quickly. Property taxes, homeowners insurance, and HOA fees can add hundreds, even thousands, monthly. For a $500K home, these could be $500 per month. Then there are maintenance and repair costs. A new roof can cost $10,000 to $30,000. An HVAC replacement, $5,000 to $10,000. Budget at least 1–3% of your home's value annually for these unexpected expenses. Don't forget closing costs. These are upfront fees for loan origination, title insurance, appraisals, and more. They typically range from 2% to 5% of the loan amount, meaning $10,000 to $25,000 on a $500,000 mortgage. Action step before committing: create a realistic budget that includes all potential homeownership costs, not just the mortgage. Aim for your total housing expenses to be no more than 28% of your gross monthly income. Now, let's talk life insurance. It's not about you, it's about protecting your loved ones financially if you're no longer there. The key decision: term life versus whole life. Term life insurance is pure protection for a specific period, typically 10, 20, or 30 years. It's like renting insurance: lower premiums, higher coverage, and it expires when you likely no longer need it. For a healthy 30-year-old, a $1 million 20-year term policy might cost $30, $50 per month. This provides significant protection during your prime earning and family-raising years without breaking the bank. Whole life insurance, on the other hand, lasts your entire life and includes a cash value component. However, premiums are significantly higher, and the cash value grows slowly, often with high fees. The cash value often yields returns lower than inflation, typically 1–3% after fees. You're essentially paying a premium for a subpar investment vehicle tied to your insurance, instead of investing independently for higher returns. Action step: for most families, the strategy is buy term and invest the difference. Purchase a term policy for protection, and separately invest the premium savings in low-cost index funds or ETFs. Determine your coverage needs by calculating 10–12 times your annual income, plus any outstanding debts like mortgages. For example, if you earn $100K and have a $300K mortgage, you might need $1.3 million coverage. Action step: review your life insurance coverage every 3–5 years, especially after major life events like marriage, birth of a child, or a significant increase in income or debt. Your needs evolve. Finally, let's explore the vulnerability of dual income households. While two incomes offer more flexibility, they often lead to accelerated lifestyle creep, where perceived needs expand with combined earnings. The trap is that many dual income families base their entire financial structure, including mortgages and car payments, on both incomes. If one income disappears, the entire structure becomes incredibly fragile. Consider the costs of childcare for dual income households. In many states, this can be $15,000 to $25,000 per child annually. This can quickly erode the second income's net benefit or even exceed it. Action step: maintain an emergency fund equivalent to 6–12 months of combined essential expenses. This buffer is crucial if one income stream is disrupted, offering a safety net during job transitions. Scenario planning is essential. What if one income is suddenly reduced or lost? Could you still cover your core expenses on a single income? This helps identify vulnerabilities before they become crises. Action step: create two budgets, a comfort budget with both incomes and a survival budget based on just one income. Understanding the gap reveals where you're most exposed and how to adjust. Many dual-income households also carry higher debt levels, such as larger mortgages or multiple car loans, because their combined income allows for higher monthly payments. This amplifies risk. Remember, financial resilience isn't just about maximizing income, it's about minimizing vulnerability. Diversify your income streams or skills where possible, and avoid over-leveraging based on current income. Even with two incomes, consider automating savings as if you only had one. Direct a significant portion of the second income directly into investments or high-yield savings before it's spent. This approach creates a built-in safety margin. If one income is lost, you've already trained your household to live on less, making the transition less painful and preserving financial stability. Consider the long-term impact on retirement savings. If one income is primarily consumed by childcare or increased lifestyle, It might mean less contribution to 401ks or IRAs, impacting future wealth. Action step: maximize retirement contributions from both incomes early on. Even an extra $100, $200 per month from each income can compound significantly over decades, reaching hundreds of thousands by retirement. Another often overlooked area: disability insurance. If you lose an income due to illness or injury, disability insurance can replace a portion of that income, often 60–70%, preventing financial collapse. Action step: review your employer's disability benefits. If insufficient, consider a private long-term disability policy. It's often more critical than life insurance for protecting your current income stream. Navigating major financial decisions requires a slow, deliberate approach. Don't rush into commitments based on surface-level information. Dig deep into the hidden costs and long-term implications. By understanding the subtle traps in homeownership, insurance choices, and dual income management, you empower yourself to build true, lasting financial resilience. Stay slow, stay smart. Even with a robust portfolio, subtle behavioral leaks can erode your wealth. We're talking about the hidden drains that often go unnoticed, impacting your financial fortress, silently undermining your long-term prosperity. Consider subscription creep. That $15 streaming service, a $20 app. Individually small, but monthly, they collectively exceed $100, $200, a significant annual drain, often forgotten. Many affluent individuals pay for unused services. A Harvard Business Review study found over 40% of subscribers forget at least one recurring payment. That's pure leakage, directly impacting your bottom line. A critical weakness: insufficient emergency funds. Experts recommend 3–6 months of living expenses. Without this, an unexpected event forces high-interest debt, jeopardizing long-term gains. Imagine a $10,000 medical bill. Without a fund, that could mean tapping into investments or racking up credit card debt at 20% plus APRA, negating years of disciplined saving and growth. The keeping up with the Joneses syndrome is a potent wealth destroyer. Social media amplifies this, pushing consumers towards aspirational purchases they can't genuinely afford, creating a cycle of debt. That luxury car or vacation fueled by social pressure isn't an investment, it's often a depreciating asset or pure consumption. A $70,000 car depreciates 20% in its first year, a $14,000 instant loss. E-commerce makes impulsive buying dangerously easy. A flash sale or limited time offer triggers instant gratification, often for items not truly needed, leading to buyer's remorse and wasted capital. A recent survey showed Americans spend an average of $314 on impulse purchases monthly. That's over $3,700 annually, which could be invested for substantial long-term growth rather than fleeting satisfaction. Free trials are often Trojan horses. Companies bank on you forgetting to cancel, automatically converting to paid subscriptions. Always set a reminder to review or cancel before the trial ends. Our brains are wired for immediate reward. Retailers exploit this with scarcity tactics and urgency. Recognizing these psychological triggers is the first step to resisting them and making rational financial decisions. The first defense: a meticulous financial audit. Track every dollar for 30 days. Identify where money truly goes, revealing hidden spending, leaks, and behavioral patterns. Categorize spending: fixed, variable, and discretionary. Use apps like Mint or Personal Capital. Many discover 10–20% of their income is spent on non-essential, often forgotten items, a significant sum. Automate your savings and emergency fund contributions. Pay yourself first before discretionary spending. Even $100, $200 transferred weekly compounds significantly over time, building a solid financial buffer. Set a clear target for your emergency fund, e.g., $5,000 for 6 months of expenses. Break it down into smaller, achievable weekly or bi-weekly savings goals, making it manageable. Combat impulse buying with the 30-day rule. For non-essential purchases over $100, wait 30 days. Often, the desire fades, saving you money and preventing buyer's remorse. Instead of buying, add it to a wish list. If you still want it after 30 days and it aligns with your budget, then consider it. This cools emotional responses, leading to better decisions. Don't eliminate joy. Allocate a specific fund money budget. This prevents feeling deprived, which can lead to overspending later. Be realistic with your discretionary allowance. If your budget allows $200/month for dining out, enjoy it within that limit. This structured freedom reduces the mental burden of constant financial scrutiny, promoting peace of mind. Shift to conscious consumption. Before buying, ask: do I truly need this? What value does it add to my life? What's the opportunity cost if I invest this instead? That $3,700 annual impulse spending, invested at an average 8% return, could grow to over $100,000 in 15 years. That's the profound power of conscious choice and deferred gratification. Schedule quarterly reviews for all subscriptions. Use tools like Rocket Money or Truebill to identify and cancel unwanted services. Many find $50 $100 in forgotten subscriptions every 3 months. Even a modest $50/month saved from forgotten subscriptions is $600 annually. Over 20 years, invested at 8%, that's over $27,000 in additional wealth simply by being vigilant. Counter social comparison by focusing on intrinsic value and personal goals. True financial independence comes from internal satisfaction, not external validation through material possessions. Prioritize experiences over possessions and long-term security over instant gratification. Your future self will thank you for delaying a luxury today to build lasting wealth and freedom. Connect your financial discipline to your deeper why. Is it early retirement, funding education, or generational wealth? This motivation fuels consistent positive behaviors even when challenging. Introduce friction into your spending. Remove saved credit card details from online stores. Use cash for discretionary spending. These small hurdles reduce impulse buys significantly. Implement behavioral nudges. Place a sticky note with your financial goals on your wallet or computer. A visual reminder can steer you away from unnecessary purchases, reinforcing your discipline. Financial health is an ongoing journey, not a destination. Regularly review your habits, celebrate small victories, and adapt your strategies as your life and goals evolve, fostering continuous improvement. By diagnosing and addressing these behavioral weaknesses, you empower yourself to plug spending leaks and build a stronger, more resilient financial future, brick by deliberate brick. Today, we tackle the long game retirement. It's easy to push future financial security aside, but delaying costs more than you think. Let's optimize our long-term wealth. Our brains are wired for present bias, favoring immediate rewards over future gains. This makes saving for decades away incredibly challenging, but it's a hurdle we must overcome. The magic of compounding is real. It's your money earning money, which then earns more money. Small, consistent investments grow exponentially over time, especially early on. Imagine investing $500 monthly. Starting at 25, you could have $1 for flan by 65. Starting at 35, only $600 K. That 10-year delay costs you $800,000? This lost money isn't just theoretical. It's the opportunity cost of what those dollars could have compounded into. Every delayed year amplifies this effect significantly. Utilize your 401k fully, especially if your employer offers a match. It's literally free money, instantly boosting your returns. Don't leave it on the table. Beyond the 401k, consider Roth IRAs or traditional IRAs. Roth offers tax-free withdrawals in retirement, while traditional IRAs provide upfront tax deductions now. Automate your retirement contributions. Set up regular transfers from your paycheck or bank account. This removes decision fatigue and ensures consistency effortlessly. If you're over 50, don't despair. The IRS allows catch-up contributions to 401ks and IRAs, letting you contribute extra to accelerate your savings for retirement. The sloth approach to retirement saving is about patience and consistency. Slow, steady contributions compounding over decades build robust wealth without daily stress. Now let's talk about the allure of get-rich-quick schemes. The market is full of them, promising instant wealth. But often they lead to significant losses, not riches. Day trading, for instance, has an extremely high failure rate. Studies show over 80% of day traders lose money over time. It's more gambling than investing. Remember meme stocks? Driven by social media hype and FOMO, these can skyrocket then plummet, leaving many retail investors with heavy losses. Don't chase the hype. Even some volatile assets like certain cryptocurrencies, while innovative, can be highly speculative. Their extreme price swings mean high risk for those seeking quick gains. Speculation often triggers emotional decisions, greed when prices rise, panic when they fall. This emotional roller coaster usually leads to poor timing and suboptimal returns. Frequent trading also incurs significant fees, commissions, bid-ask spreads, and short-term capital gains taxes. These can erode any potential profits quickly. Loss aversion makes us hold on to losing positions too long, hoping for a rebound. This can turn small losses into devastating ones, tying up capital in poor investments. In the speculative arena, the house often wins. Professional traders and institutions have advantages in information and technology. Retail investors are usually at a disadvantage. True investing is about long-term growth based on fundamentals. Speculation is betting on short-term price movements, often detached from actual value. Understand the difference. So, what's a better path? Index funds. They offer instant diversification, tracking broad market indices like the S&P 500, giving you exposure to hundreds of companies. Historically, the S&P 500 has returned an average of about 10% annually over the long term. This consistent, market-level growth is a powerful engine for wealth accumulation. Index funds typically have very low expense ratios, often less than 0.1%. This means more of your money stays invested and compounds rather than being eaten by fees. By investing in an S&P 500 index fund, you own a tiny piece of 500 large U.S. companies. This diversification significantly reduces your risk compared to individual stocks. Passive investing with index funds requires minimal effort. You buy, hold, and let the market work. No need for constant monitoring or trying to beat the pros. Even with passive investing, occasional rebalancing is wise. This means adjusting your portfolio back to your target allocations, perhaps once a year, to manage risk. Embrace your inner sloth investor, patient, calm, and consistent. Let time and compounding do the heavy lifting, rather than chasing fleeting market fads. Prioritizing early retirement savings and choosing diversified, low-cost index funds over speculation is the proven path to long-term financial freedom. Stay steady, stay wealthy. We've journeyed through the subtle traps, lifestyle creep, bad debt, and the illusions of conventional success. These aren't just mistakes, they're the default settings of the financial matrix. From unchecked subscriptions to investment pitfalls, we've identified the leaks. Now, it's time to transcend the normal and forge a path to true financial independence, not just solvency. Let's reevaluate credit scores. They're a tool, not a report card for your worth. A high score helps secure low-interest mortgages or business loans, potentially saving you tens of thousands. However, chasing a perfect score to enable more borrowing for depreciating assets is a trap. Optimal use means minimizing debt, not maximizing access to it. Aim for a score that serves your goals. A strong credit score, say 760 plus, helps you secure a 3% mortgage rate instead of 4%. On a $400,000 loan, that's over $70,000 saved in interest over 30 years. Use it wisely. The normal loop is insidious. Increased income leads to lifestyle creep, then more debt to maintain it. This cycle robs you of future capital. It's the silent killer of wealth accumulation. The average American household carries $10,000 in credit card debt, often at rates exceeding 20%. This isn't normal, it's a wealth drain. Every dollar spent on interest is a dollar not invested. The normal pursuit of a larger home, new car every few years, and expensive experiences often means sacrificing retirement savings. Don't trade future freedom for present vanity. The cumulative effect of these normal choices is a life tied to the paycheck. It's a subtle form of financial slavery. Break free by consciously rejecting the conventional consumption narrative. The paradigm shift begins now. Instead of asking, what can I buy? Ask, how can I invest this to buy my freedom? Shift from passive consumption to active asset accumulation. This means every dollar has a job. It either covers essential needs, pays down high-interest debt, or builds your asset base. No more aimless spending, every transaction is intentional. Imagine redirecting $500 monthly from discretionary spending to a low-cost S&P 500 index fund. Over 30 years, at an average 10% return, that's over $1 million. The power of compounding is immense. Your action plan starts with a budget. Not deprivation, but intentional allocation. Use the 50-30/20 rule. 50% needs, 30% wants, 20% savings/debt repayment. Or even better, 70-0/30. Next, build a robust emergency fund. 3-6 months of essential living expenses, liquid and accessible. This protects your investments from life's inevitable curveballs. Tackle high-interest debt aggressively. List all debts by interest rate. Attack the highest rate first, avalanche method, or the smallest balance first, snowball method. Free up your cash flow. Maximize tax-advantaged accounts. Contribute to your 401k up to the employer match, that's free money. Then, fund a Roth IRA or traditional IRA up to $7,000 for 2024. Invest simply and broadly. Low-cost index funds like VOO or SPY, tracking the S&P 500, offer diversification and historical average returns of 10% annually. Avoid stock picking unless it's a hobby. Automate everything. Set up automatic transfers to your savings and investment accounts on payday. Pay yourself first, always. This removes the temptation to spend it. Consider passive income streams. Real estate, dividend stocks, or even a side hustle can accelerate your journey. An extra $500, $1,000 monthly can drastically cut your working years. Continuously educate yourself. Read books like The Simple Path to Wealth or I Will Teach You to Be Rich. Financial literacy isn't a destination, it's an ongoing journey of optimization. Here's a timeline: Month 1, 3 budget and emergency fund. Month 4, 6 debt payoff. Month 7 plus automate and invest. Use apps like Unave for budgeting, Fidelity/Vanguard for investing. Checklist 1, zero-based budget 2, 3 6-month, emergency fund 3, high-interest debt eliminated 4, 401k matched 5, Roth IRA max 6. Automated index fund investing. This is your foundation. The power to redefine your financial future is yours. Stop being a passive consumer, become an active architect of your wealth. Your choices today determine your freedom tomorrow. Don't let normal steal your freedom. Break the loop. Build your legacy. Your journey to financial independence starts the moment you choose conscious control over default consumption.